Gold and silver are in outright free fall right now. This is not a slow drift, not a healthy pullback, not consolidation. It is a straight drop. As I'm recording this, gold has just fallen through 4,600. Silver is trading around 72. Every time I refresh the screen, the numbers are even lower. There is no pause. This is no longer a normal correction. This is a crash unfolding in real time. Friday was expected to mark the worst point. Silver down 38%, gold down 16%, the worst single-day move in 45 years. Most people believed that was the end of it. They thought the selling pressure had burned out. They thought the bottom had already formed. But what we are seeing now is total liquidation, forced selling, margin calls rippling through the system one after another. Traders are being erased one position at a time, one account at a time, and instead of slowing, the process is speeding up. Welcome to the hidden economy. Here, I break down what is really happening in financial markets, while everyone else is distracted by surface-level headlines. Make sure you subscribe because this type of analysis is rarely talked about anywhere else. If this video is helpful, hit the like button. Thousands of traders rushed to sell their silver ETFs when the market opened this morning. Their orders were rejected. Circuit limits were breached. Friday's sell-off was so extreme that today's prices are still below the allowable circuit threshold. Anyone who held positions over the weekend is now stuck, unable to sell at any price as gold drops below 4,500 and silver plunges under 72. So what caused this? The tool being used is called a margin hike. In futures trading, you only post a deposit, usually around 10%. To control $100,000 worth of silver, you might only need $10,000 up front. But if the exchange raises margin requirements overnight, you must add cash immediately, or your position is forcibly liquidated. The exchange automatically forces you out at whatever price exists at that exact moment. And when everyone is being liquidated at the same time, that price is disastrous absolute bottom, the worst exit imaginable. One margin hike is manageable. Most traders keep a buffer, extra cash on the sidelines for moments like this. But what happens when there are 2 margin hikes? 3, 4? What if there are 8 margin hikes in just 8 weeks? That is no longer survivable. That is systematic elimination. That is exactly what happened. 8 margin hikes in 8 weeks. Each one engineered to pull more cash out of long positions, each one tightening the pressure further. Throughout December and January, traders were hit again and again, never given time to recover. A hike on Christmas Day, another over New Year's weekend. Every time traders thought they could recover, another increase landed. And then came the final blow. On January 13th, everything changed. Margins were switched to a percentage-based system. Now when silver prices rise, margin requirements rise automatically. A self-tightening trap that punishes strength itself. And it didn't end with Friday's bloodbath. Another hike followed Monday morning, then yet another later in the week. 8 hikes in total. All of 2024 saw only 2 margin hikes. 2023 had 3. 2022 had 2. 7 hikes across 3 years was considered normal. 8 hikes in 8 weeks has never happened before. I reviewed 2 decades of historical data. Every hike triggers forced liquidation, and forced liquidation drives prices lower. Falling prices then trigger margin calls on traders who weren't even impacted by the original hike. That leads to even more selling, even lower prices, a deliberate death spiral. That spiral is exactly what you are witnessing now. Gold around 4,500, silver near 72, and still dropping. But there is one detail that kept me awake last night. On the same morning as the latest hike, the Shanghai Gold Exchange raised its margins from 20% to 26%. Chicago and Shanghai separated by 14 time zones acting on the same day in the same direction. The United States and China rarely agree on anything. Yet, on silver margins, they suddenly moved in perfect sync. That does not happen unless both sides fear the same risk. 356 to 1. That is the ratio of paper silver to physical silver on the COMEX. For every single ounce of real metal in a vault, there are 356 paper claims. 1 physical ounce backing 356 promises. This system works as long as everyone settles in cash. But once investors begin demanding physical delivery, the math collapses, and those demands are now happening. In the 3rd week of January alone, 33 million ounces of silver physically left COMEX vaults. This was not paper trading, it was metal removed, loaded onto trucks, and taken away. In just 1 week, 26% of total inventory disappeared. 4 years ago, COMEX held around 430 million ounces. Today, that number is down to roughly 113 million. A staggering 74% is gone, and the pace is speeding up. In the first week of January, 7 million ounces exited. By the 3rd week, it was 33 million. This is no longer an orderly withdrawal, it is a stampede. The speed of removal is accelerating, signaling urgency and fear among those demanding physical silver instead of paper exposure. So who is taking all this silver? It is not small retail buyers. Moving 33 million ounces requires logistics, security, and large-scale storage. This is institutional demand, industrial users, sovereign entities, and well-capitalized players. Smart money is emptying the vaults ahead of March, and here is why March is so important for the silver market. March futures contracts represent 528 million ounces of promised silver. That is the total amount owed to traders holding March delivery contracts. Against that, the vaults contain only 113 million ounces. Read that again, 528 million ounces promised, 113 million ounces available. Nearly 5 times more silver has been sold on paper than physically exists. The first notice day is March 27th. On that date, every trader holding a March contract must choose between cash settlement and physical delivery. If only 22% of those traders request delivery, the vault is completely drained, not strained, not stressed, but empty. That is the nightmare scenario exchanges are desperately trying to prevent. This is the real reason behind the coordinated margin hikes. The goal is to flush out long positions before physical delivery exposes the imbalance at the heart of the system. And it is working. Look at prices. Right now, gold around 4,500, silver near 72. Long positions are being wiped out, yet the signal is clear. This is engineered. Compare 2 prices at the same moment. COMEX silver, the paper price shown on financial television, is trading near 72 and falling. Now look at Shanghai silver, where real metal is exchanged about 100. Same metal, same day, same world, yet a massive price gap that reveals paper silver is artificial and physical demand tells a very different story. Shanghai is not collapsing alongside New York. Physical silver is holding its ground while paper silver is in free fall. Think carefully about what that implies. If this were a genuine market crash driven by real supply and demand, both markets would be falling together. Paper and physical prices would move in sync, but they are not. Paper is collapsing, physical is stable. That contrast tells you everything you need to know. The paper price is being forced lower. The physical price reflects reality. One of these prices is false, and it's not hard to tell which one. Now look at who benefits from that distortion. JP Morgan holds the largest silver short position ever accumulated by a bank built over more than a decade. For every dollar silver falls, they generate hundreds of millions in profit. Bank of America also carries enormous short exposure. HSBC does as well. These institutions sit on CME committees. They can see positioning across the market. They understand exactly where the pressure points are. On Friday, everyday traders lost 38%. These banks made billions. Today, as gold breaks below 4,500 and silver sinks under 72, they are earning billions more. I am not accusing anyone of illegal behavior. Short selling is legal. Participation on exchange committees is legal. I am simply pointing out that the players who profit the most from this collapse are the same ones with the greatest influence over exchange rules. The timing of last week's events is also critical. On Thursday evening, Reuters released a report claiming the U.S. government was ending support for strategic metals. Based on anonymous sources, algorithms reacted instantly, and selling cascaded through the market. 3 hours later, the U.S. Energy Department issued a statement saying the article was false, but the damage was already done. That same Thursday night news leaked about Kevin Warsh being nominated as Fed chair. Hawkish. Negative for metals. The official announcement came Friday morning, but insiders already knew the night before. Fake headlines, leaked appointments, 8 margin hikes, all compressed into the same time window. Is that really a coincidence? There is another detail almost no one is talking about. The day before the crash, there was highly unusual options activity in silver ETFs. Massive put buying appeared just hours before prices collapsed. Someone placed very large bets that silver would fall right before it did. Either that was extraordinary luck or someone knew exactly what was coming. Now, consider what happened to traders who tried to exit their positions. Many were unable to. In China, the UBS SDIC Silver Fund was completely halted. An entire trading session passed with 0 transactions. In the United States, ProShares Ultra Silver fell by 62%. 62% of capital erased in a single trading session with no exit. The Silver Trust run by iShares plunged 31%, marking the worst single day in the fund's entire history. Traders rushed to sell, but orders were repeatedly rejected. Platforms flashed error messages, systems buckled, and phone lines stretched to waits exceeding 2 hours. One trader tried closing his futures position non-stop for 18 hours, every order rejected, forced to watch losses compound. Even late last night, traders were still reporting problems accessing accounts. Days later, many remain unable to view balances or place trades effectively locked out. First, the price collapsed, then exits were blocked, and then margin requirements were raised again. Consider that sequence carefully: crash, lock, raise. This is exactly how long positions are systematically wiped out. The fundamentals make this collapse even harder to justify. Silver has been running a supply deficit for 5 straight years. Solar panels, electric vehicles, AI chips, and smartphones all depend on it. Demand keeps accelerating while mine supply remains flat. Since 2019, cumulative deficits total 1.3 billion ounces, roughly 18 months of global production already consumed. Then China shut the gate. As of January 1st, 2026, silver was added to China's strategic materials list. Export licenses became mandatory, and export volumes fell about 40%. China refines roughly 65% of the world's silver and has effectively told Western buyers to look elsewhere. There is nowhere else to look, and the damage goes far beyond traders. This collapse is tearing through real businesses worldwide. In India's Rajkot jewelry hub, 44 firms filed for bankruptcy in 1 week, with losses near $425 million. In London, 2 hedge funds halted redemptions due to silver losses. In Dubai, physical silver premiums surged to 15% above spot as dealers struggle to source metal. When you connect the dots, the picture becomes clear. A 5-year supply deficit, surging industrial demand, Chinese export restrictions, and yet collapsing prices only make sense if paper markets are being forced lower ahead of March delivery. I believe physical metal ultimately wins. Paper claims can be created endlessly. Real metal cannot. For now, though, paper remains in control. Gold at 4,000, 500 silver at 72, and long positions are being crushed. So what comes next? Where does this collapse finally stop? The honest answer is that nobody knows the exact bottom. Anyone claiming certainty is not being truthful. In a crash of this nature, price targets lose meaning. Support levels that were supposed to hold are breaking effortlessly. What matters now is not price, but signals. There are more important indicators than chart levels, and right now those signals are worsening. Still, this is not the end of the story. The Shanghai premium is not falling with paper prices. Physical buyers are still paying close to 100, while paper silver trades near 72, revealing a critical divergence. If this were a fundamentals-driven collapse, physical prices would be falling too. They are not. Physical silver is holding firm. Lease rates have surged to around 10%, roughly 20 times normal levels. Institutions are scrambling for metal. You do not pay 10% to borrow something you expect to be cheaper soon. You pay that rate because supply is scarce and urgent. The vault drain has not stopped. Smart money continues taking physical delivery 33 million ounces last week and likely more this week. While retail traders panic and liquidate paper positions, institutions are lining up trucks and removing metal from the system, signaling confidence in physical value despite collapsing paper prices. March open interest remains unusually high. Despite price collapse, repeated margin hikes, and intense pressure, traders are still holding March contracts. They still want delivery. Fundamentals have not changed. The supply deficit is real. The shortage is real. China continues limiting exports. Industrial demand keeps growing day after day. The only thing that has changed is the paper price. It has been forced lower through 8 margin hikes and cascading liquidations. Eventually, paper must reconcile with physical reality. History shows this outcome every time. The real question is how much damage occurs before that happens, and how many traders are wiped out along the way. Crashes do not eliminate wealth, they redistribute it. On Friday, wealth shifted from retail traders to banks. When the reversal comes, it shifts back. Paper trades at 72, while physical trades near 100. That spread will close at some point, and someone will profit. The question is which side you are on when it happens. Here are the metrics I am watching closely. First is the Shanghai premium around $28. This gap shows the difference between paper claims and physical reality. Next are COMEX vault levels reported weekly. If another 20 to 30 million ounces leave, inventories may be exhausted before March. Finally, watch lease rates. At 8 to 10% today versus a normal level near 0.5%, they signal extreme stress. Lease rates reflect what institutions pay to borrow physical silver. When they spike this sharply, it means physical metal is scarce, difficult to source, and increasingly disconnected from collapsing paper prices. The last 2 occasions when lease rates surged to levels like this were in 1980 and 2011. In both cases, major moves followed shortly after March open interest came into focus. The key question now is how many contracts are still open for March delivery. When traders give up in close positions, open interest falls. When they hold on, open interest stays high. Elevated open interest heading into first notice day signals delivery stress, and that is exactly what the exchanges are trying to prevent. That is why trading halts, platform outages, and account lockouts matter. If more funds are halted, more platforms freeze, and more traders report being locked out, it tells you the system is under strain. Healthy markets do not freeze. Stressed markets do. Shanghai premium vault levels, lease rates, March open interest system stress. Track these indicators closely. The data shows what is happening long before the broader market understands it. A widening Shanghai premium means paper is losing credibility. Spiking lease rates mean institutions cannot source physical metal. Platforms freezing mean the plumbing of the system is failing. These are not abstract statistics. They are warning lights. And this is what you need to understand about what you are witnessing right now. This crash is not accidental. It is not normal market behavior, and it is not simply profit-taking after a rally. 8 margin hikes in 8 weeks. An unprecedented move where CME and Shanghai act on the same day, unlikely coordination between rivals. Unusual options activity appearing just before the collapse. A new player entering the picture. A $28 gap between paper and physical prices. A divergence that should not exist in a functioning, efficient market. Vault inventories draining at 26% per week. Smart money rushing into physical delivery. Traders locked out of accounts, unable to exit. 44 firms bankrupt in India. Hedge funds suspending redemptions. Physical premiums spiking worldwide. This is not a correction. This is a coordinated assault on long positions designed to force them out. Ahead of March delivery demands exposed the fractional reserve nature of the exchanges, and it is working. The pressure campaign is working. Long positions are being destroyed right now. Gold at 4,500. Silver at Hutitvoa. Yet the fundamentals remain unchanged. The shortage is real. The deficit is real. Physical silver trades near 100 while paper trades at 72. Eventually this process ends. Paper must reconcile with physical. It always does. The real question is whether you make it to that point. Can you endure the pain? Did your stops get triggered? Did margin calls force you out? The trader who messaged me Sunday night did not make it. He was right on the fundamentals and still got wiped out. So ask yourself honestly tonight, do you truly understand your exposure? Do you have a clear exit plan? Is your position sized for survival, or are you one margin call away from losing everything? In markets like this, the winners are not the ones who predict perfectly. They are the ones who survive, who manage risk, who stay calm while others panic. Survive first. Act once clarity returns. This is not financial advice. Your money, your responsibility. But if you are watching gold fall through 4,500 and silver break below 72, you need to understand what you are actually seeing. You need to grasp the full picture: margin hikes, coordination, divergence between paper and physical, and relentless vault drain. That is what this analysis has laid out the complete picture. Gold at 4,500. Silver at 72. Shanghai near 100. That spread is shouting. Paper and physical cannot remain this far apart indefinitely. When the gap closes, someone will have bought near the bottom. Someone will have held through the pain. Someone will have recognized what others ignored. That person could be you, or you could be the trader who messaged me Sunday night. The difference is not luck. It is risk management. Share your thoughts on this crash in the comments. Pass this on to someone who needs to see it. Subscribe if you want ongoing coverage. I am tracking this daily until it breaks. See you tomorrow.